right, hey there. I'm going to do a quick unscripted trial run of using Gemini's new Flash model to use their share screen functionality, which allows you to share your screen with Gemini and have the model kind of see what you're looking at and ask questions while it looks at your screen. I've always thought these tools are really interesting for self-directed learning, and I had an idea in my run to try something out, and so I'm going to give it a shot. So the first thing I'm going to do, I'm going to come into ChatGPT, and I'm going to ask ChatGPT to create a hypothetical stock or mutual fund ETF portfolio for me to use in a tool called Portfolio Visualizer. So let me go ahead and do this. And I usually like to just talk to these tools. It's a lot easier than typing. You can be pretty informal, and they pretty much understand what you're trying to get at. So here we go. I'd like you to create for me a hypothetical mutual fund and ETF portfolio. I want to have 5 to 7 different assets, and I want it to be a diversified portfolio. I don't want anything too simple. Just give me something that is well diversified, that I could use to kind of test a few different ideas. And I want you to output the ticker along with the percentage. Okay. Probably could have asked for something different, but let's see what it gives me. All right. So it's going to rattle off some large cap, international, small cap, emerging markets, real estate, fixed income, and commodities. Okay, pretty straightforward. And I'm going to come into this tool, Portfolio Visualizer. My friend Nick pointed this out to me a couple weeks back. I had used it a long time ago. I tried it again earlier today, and it's pretty awesome. It's free for the most part, but you can put in a portfolio and have it analyze it. It's very, very cool. So let's create a portfolio here based on what ChatGPT told me. And again, this is just to play around. So 30 EX US 20 VB 15 IMG 10 PNQ 10 BND 10 and DBC 5. Okay, sweet. Let's see. Okay, analyze it. And let me just customize this real quick. Add some more. You can kind of add like a style analysis and a factor regression, so get more kind of interesting information. But then you can analyze your portfolio, and it gives you a ton of information, right? Like your annualized returns, standard dev, your ratios, your correlations, bunch of different interesting graphs, and then some really kind of deep in the weeds stuff. So like risk and return metrics, a bunch of different attributes, some of which I remember, some of which I don't. It does a nice little factor regression against these factors. When I was working on this stuff on a day-to-day basis, I could kind of remember what these things are, but hey, it's, I'm doing new things now. So these things aren't like in the brain. So it's kind of hard to remember what all these things mean. Anyways, my intent and what I'm hoping to do is see if Gemini is any good at helping me understand this. So what I'm going to do is I'm going to go back to the Gemini, and I'm going to share my screen, the backtest portfolio, and let's see what happens.
Okay, you are looking at the backtest portfolio screen and are about to see what happens. Are you expecting to see a specific outcome?
I just really need help interpreting this analysis, and I'm hoping you can help walk through some items that are a little bit confusing for me.
Certainly, I see that you have a backtest portfolio asset allocation on the screen, and you'd like help interpreting the analysis. You also mentioned some items are a little confusing, so let me know what you would like me to help you with, specifically.
Yeah. Okay. First of all, can you just like this performance summary? Can you just give me an overview? Like, what should I be looking at here, and what are the key takeaways?
Sure, let's look at the performance summary. The key metrics compare your Portfolio 1 with the Vanguard 500 Index Investor. The start balance for both is $10,000, and the end balance shows that Portfolio 1 ended with $21,822 versus $34,623 for the Vanguard 500 Index Investor. The annualized return is 8.19% for your portfolio versus
Okay.
13.34.
Yeah, I don't need you to just like read it off, but like for things like the ratios and stuff, give me some. How should I interpret those? Like, what do those mean? Like the Sharpe ratio and the Sortino ratio. How should I be thinking about those things?
Certainly, let's discuss the Sharpe and Sortino ratios. The Sharpe ratio measures risk adjusted return, where higher values are better. It looks at the return relative to the total risk of a portfolio. The Sortino ratio focuses specifically on downside risk, and it also favors higher values. So, when evaluating the Sharpe and Sortino ratios of Portfolio 1, it is important to compare those numbers with those from the Vanguard 500 Index Investor, where in both cases they are higher.
Okay, that's kind of high level. Anything else? Like anything else to add there? That was a little generic.
Okay, I can definitely elaborate. The standard deviation measures the volatility of the portfolio, and the maximum drawdown represents the largest drop from a peak to a trough during a specific period. The benchmark correlation shows how closely the portfolio moves in line with the benchmark, with 1.00 being perfect correlation. Is there anything else on the summary that I can help with?
Um, no, I think the next thing I'm interested for you to take a peek at is this table. It's like a factor regression. Can you give me an overview? Like, what is this trying to tell me, and what should I take away from it?
Of course, the factor regression table is designed to show how your portfolio's returns are related to different market factors, such as market risk, small cap stocks, and value stocks. The values under the RM, RF, SMB, and HML columns represent the exposure of your portfolio to each of these factors, and a higher value means a stronger correlation to that factor. Additionally, the annual alpha value indicates the returns generated by the portfolio above what was expected by its factor exposures. In your portfolio, the exposure to market risk is close to 1 across most investment categories.
Okay, so let's look at international developed ex-US. You said something about the annual alpha, right? In the graph, it's negative 0.53%. Like, what does that actually mean? Please describe that to me.
Certainly. The minus zero, 53% annual alpha for international developed ex US means that this specific investment within your portfolio underperformed relative to what would have been expected given its exposure to the market, size, and value factors by minus 0.53% on an annual basis. This can also be referred to as negative alpha. It indicates the stock selection and strategy used for this particular portion of the portfolio was not effective, given the other factors it is measured against. Does this help clarify what the annual alpha means?
Yeah, can you give me like a more simplified example just so I make sure I fully understand it?
Absolutely. Let's imagine two hypothetical investors, both investing in the same international stock market with the same market exposure. Investor A uses a passive index based approach, so their annual alpha is 0%. Investor B is more active, selecting stocks and trying to beat the market. Investor B, after a year, ends up having an alpha of minus 0.53%. In that scenario, it would mean that, relative to other factors, their specific choices resulted in underperformance. Does that example help to simplify the concept for you?
Yeah, that makes sense. Earlier, you talked about like RM minus RF, SMB, HML. Can you explain those again to me? Like, what do those things actually mean?
Yes, I can explain those again. The RMRF stands for market risk premium, which is the excess return of the market over a risk free asset. SMB stands for small minus big, representing a premium from investing in small cap stocks. HCML stands for high minus low, representing the premium of investing in value stocks. which are stocks with low valuation metrics, such as book to market ratios. These are the different factors that your portfolio's performance is compared against to calculate the annual alpha.
Okay, but like what does this like 0.08 mean? Can you walk me through how this is calculated?
Certainly, let's look at the 0.08 under the HEML column for the United States portion of your portfolio. This value represents the portfolio's exposure to the value factor, meaning that the returns of this specific part of your portfolio have a positive correlation with value stocks. This specific number is a coefficient from the regression, which means that for every 1% increase in the return of the HML factor, the returns of the United States segment of your portfolio would increase by 0.08%. On average, all other things being equal. These coefficients are calculated through statistical regression analysis, which estimates how returns of each portfolio segment respond to changes in the market factors.
Okay. And then one column we didn't talk about. What are these T columns? What do those mean?
The values in the columns with T, RM, RF, T, SMB, T, HML, and T alpha are T statistics. These are measures of statistical significance indicating whether the regression coefficients in the previous columns, RMRF, SMB, HML, and annual alpha, are statistically different from 0. A larger T statistic suggests stronger evidence that the factor, or alpha, is significant in explaining the portfolio's returns.
But how should I interpret the magnitude of those values? Like what is 8.49 compared to 0.75 mean?
Okay, let's compare the T statistics of 8.49 and 0.75 in your portfolio. The T statistic of 8.49 associated with the small cap ETF investment is considered to be statistically significant. This means that the portfolio's exposure to small cap stocks is statistically significant and is not likely due to random chance. On the other hand, a T statistic of 0.75 associated with the international developed ex-US investment indicates that its exposure to the HML factor is not statistically significant. It suggests that the observed relationship between the portfolio's returns and the HML factor might be due to random chance, and that its exposure is not statistically different from 0. In other words, the HML factor is not that significant in the returns of that investment.
Got it. Okay. I guess one more question here. What does the T alpha mean and what does the R squared mean? Can you explain those in simple terms? Okay. I think it got something went wrong. I think it got sick of me talking. But anyways, it's probably good timing anyways. It's pretty interesting. Like the answers are okay. Um, they weren't great, but it's kind of cool how you can kind of just like pop up your screen and point to different locations, like ask questions on your own terms, and it gives you some like reasonably good answers. So this is a really cool tool, I think, for self-guided learning, and it's only going to get better. I mean, this just shipped, and I don't know, for people who are curious and want to dig in, like this is a really cool tool that you can use for free right now. So you should definitely check it out.